And the rest of the panel back into the discussion here. David, the markets are reacting, no doubt about it, and equities are softer. They've moved to the downside. We've seen rates spike higher, but it all in the context of where we've been over the last several weeks seems as though the markets were kind of anticipating this. What does this then say about the way that the landscape sets up for the early part of 2023 and whether the Fed will continue its rate hike campaign, albeit perhaps at a slower pace or for a little bit longer than it did, but with smaller increments?
Well, I think the market was anticipating something more dovish in the dots than we've got here, because if you look at the Fed funds futures market as of this morning, it was looking at a terminal rate between 4.75 and 5, not between 5 and 5.25. But what I think is really interesting is, in some ways, the Fed is more hawkish than that, because what they're saying is that by the end of the year, they'll still be between 5 and 5.25 at the end of 2023. And as of this morning, futures markets were pricing in the idea that the Fed is already going too far and will have to cut rates twice at the end of this year. So I think there's going to be a major argument here sort of between the Fed and the markets, where the markets are saying you're overdoing it, you're going to put this economy into recession here, and that's why you're going to end up having to reverse course. So I do think I think this is a mistake. I think the Fed is trying to be hawkish to, show how resolute they are against inflation, but inflation's fading anyway. And it's not worth putting the economy into recession just to hit your inflation target, a year earlier than you thought you were going to. Inflation's coming down anyway. So I'm disappointed by this, but I think this is more hawkish than markets expected.
Although, John Bellows, let's remember how dovish the dots turned out to be coming into this year and how wildly they underestimated the actual trajectory of inflation and rate hikes. So could we live through an episode like that again, to David's point, where the Fed does come around to the markets? If anything, the dots are one of the most lagging indicators that we have.
I think you're on a good point. There certainly is a little bit of a dissonance between the dots and the market. But the thing I would emphasize is that the degree of that is much smaller than it has been, and certainly much smaller than the volatility that we've realized in the market, over the last 9 months. So we've been in a market where the surprises have been very large and the Fed surprises have been even larger, and that's been really challenging. It's been challenging for equities, it's been challenging for bonds. And as we progress, we're getting closer to the point where there is a convergence. There is a little bit more clarity on the outlook. I think Powell in his press conference is going to talk a lot about kind of his forward-looking expectations. And we're going to see less volatility as a consequence. And I think that's generally a good thing. So the thing I would emphasize here is there's a little bit of dissonance left, but it's a degree smaller, multiple degrees smaller than the volatility we've experienced. And that's a big transition. And it's a transition that I think will generally be supportive of financial markets, some resolution of the uncertainty, some convergence. And that forward-looking policy that I said earlier, I think that's generally a good thing, and I think that's where we're headed.
All right, so viewers, an update for you guys right now, and those listening on Sirius XM channel 112. Markets are at session lows. The NASDAQ Composite is off almost 100 points. The S&P is down about 27, handles call it. That just kind of, so to speak, I'm checking it right now to about 20, so half of 1% declines. The Dow is now down 165, 170 some points. Mona, this is a good time to bring you back into the conversation here as well. We started you off with kind of the macro picture and what the expectations were. The way that the markets are shaping up right now seems to indicate, at least, that the initial part of next year could be a little bit more, say, biased to the downside, but maybe not as volatilely so as it's been. If you stack things up with the data that we've seen today from the Fed and the CPIs and the PPIs and everything else, does this then still mean that the path of least resistance for stocks is lower? Do we test the lows? Do we set new ones here in early 2023?
Yeah, it's a great point. And look, I think to John's point earlier, we are headed towards a 5% plus terminal rate, according to today's dot plot. But really, the market wasn't too far off of that. And so 5% or so means probably two more 25 basis point rate hikes. Maybe the Fed is giving itself some room in case inflation does become more volatile. But I also agree with David that inflation is starting to show signs of rolling over. And there are several leading indicators that we follow that do indicate that inflation will probably continue to move in this downward direction. Interestingly, I do think the Fed is being a bit conservative. So they have 3.5% core inflation by the end of 2023. I think there have been so many calls that the Fed has been wrong on inflation to the upside that now they want to be a little bit more cautious to the downside. And perhaps the same way they're giving themselves a little bit of room in the Fed funds rate. Now, to your point on do we retest the lows, certainly we think there's a period of volatility ahead of us as we get through not only an economics downgrade, but the earnings downgrade that was mentioned earlier. But that being said, this is what we are calling the worst kept secret on Wall Street. You know, this recession or this period of economic downturn is well known and established by not only Wall Street, but a lot of people are talking about it already.
Yeah.
We do think that if markets do enter a period of volatility, it could potentially be short-lived in that they will start very quickly then looking towards this period of recovery ahead.
Sure.
And keep in mind, when you do look at history, the analysis shows us that markets actually start recovering anywhere from 3 to 6 months before a recession ends. And so these forward-looking markets, we think, continue in 2023 for sure. And really, we start transitioning from defensive portfolios to more recovery portfolios.